This is the problem when you try to write something that is to reorder the entire global trading system. You never know what the unintended consequences are going to be.
Joe Calhoun, let's talk about something you wrote in your commentary for this week. And I'll just give you the phrase restructuring the global trading system. And that is a phrase that is in the essay or the epistle or whatever you want to call it that was written by Stephen Miran back in November, who is Trump's chairman of the Council of Economic Advisers. It sounds simple, but I don't think it is.
Yeah, it's pretty ambitious. We're just going to restructure the entire global economic system. Well, look, I will give them him and well, first of all, I've said a couple of times that I do believe that this was essentially a job application. I think that he had his marching orders. It's like, hey, here's what we're going to do. You need to come up with an intellectual framework that makes this make sense. And so he did. Unfortunately, well, he tried. I don't think he really accomplished that. It is a very, very confusing document. Let me just say that. Uh, he goes through. Look, it's extraordinarily detailed. But essentially, it just requires so many things to go the right way, and they've already gotten off on the wrong foot. His At the end of this big long, the epistle, by the way, I thought that was good. The epistle of Miran. Anyway, when he gets to the end of this 41-page thing, he says, "Well, what I expect is that the dollar will, we'll do the tariff stuff first, and then the dollar stuff will come later, because that's, by the way, there's two parts to this. What they want to do is impose tariffs that will generate revenue, but also not just generate revenue, it's also going to rebalance global trade. And by rebalancing global trade, he means to reduce our trade deficit. And so the two parts of that is the tariffs and the dollar. Now, involved in the tariff side too is the budget deficit, because we've talked about this so many times, Bob. Look, the trade deficit really doesn't have anything to do with. It's not because of a lack of tariffs. It's because we spend more than we make. That's really the bottom line. So that's part of it. But it's amazingly that's the smallest part of this paper is about the budget. He just kind of assumes that we're going to cut a bunch of spending. That doesn't seem to be happening, and I think it's going to be. And listen, if you look at what the Trump administration has talked about, they're talking about raising revenue through tariffs, but then using that revenue to do tax cuts. So if that just offsets, then you don't do anything to help the budget deficit. It's just the same. And that assumes that you know exactly what the impact of all those things are going to be. So we don't know those things. But anyway, back to the confusing part. This is the problem when you try to write something that is to reorder the entire global trading system. You never know what the unintended consequences are going to be. So one of the things that's going on right now, he said that he thought that we would do the tariffs first, then would come the dollar stuff. And so what he expected was that the dollar would remain strong. You would have a strong dollar at the beginning, because tariffs, when we impose tariffs on another country, you get what's called currency offset, which means the dollar goes up and the other currency goes down. Well, there's the beginning of our problem, because immediately that didn't work. The dollar went down instead of up. And the reason it went down instead of up is because President Trump focused on another part of this epistle, which was that we're going to try to get the rest of he called it burden sharing. And what he means by that is, look, we've talked about this so many times, Steve and I especially. And by the way, we're missing Steve this morning. We're doing this a little early because I'm on the road. Steve's still in bed, we think. We're not sure. But anyway, we've talked about this, how, the U.S. has been kind of the global policeman for a long time, and that's expensive. It is expensive, but there are also benefits to it as well, which people don't want to acknowledge, but there are. But anyway, his point was, let's get some of these other countries to pay more, then we can pay less and concentrate more on domestic things. It doesn't sound like a bad idea. But again, there are consequences to that. So what President Trump has done from the beginning here, since the beginning of his term, he's talked about Canada. Oh gosh, we're going to make Canada the 51st state, and we're going to take over Greenland, and we're backing away from NATO. So look, in some ways, that's what he's talking about. He wants Canada to spend more on defense, so that we don't have to spend so much to defend Canada. President Trump obviously has different ideas. He just wants to take the whole, put the whole thing together with make it part of the United States. But the idea here was to get Canada to spend more on defense. And the idea was to get Europe to spend more on its own defense. Well, because of the way he went about this in an adversarial way, well, they're doing it. But the problem is that if Europe spends more money on defense, and by the way, just to give you some round figures here, and these are not exact, but they're round figures. Germany has now passed through their legislature some bills they're going to spend $1 trillion on infrastructure and defense over the next 10 years, and the EU is going to spend another trillion. So $2 trillion in capital is going to have to be spent, and it's got to come from somewhere. Well, guess where it's going to come from? Well, European pension funds and individuals and companies and everything have been investing in the United States. A lot of that money is parked in treasuries. It's parked in the S&P 500. Well, guess where it's going to come from? You got to get that money from somewhere. If you're going to spend all that $2 trillion in Europe, it's got to come from somewhere. It's going to come from here because that's where it is. Same thing with Canada. Canada last month was a huge seller of treasuries. Why? Well, because they're going to have to spend more on defense, and it's got to come from somewhere. And so the effect of that has been that the dollar's fallen. So right off the bat, their idea was, we'll have these strong tariffs, or we have these tariffs, it'll make the dollar strong, and then we can go about doing all these other things. Well, it didn't work. They've already kind of blown it. And so, I don't know. Contradictory. That's the thing. That's the word that I keep coming back to when I read this thing, was contradictory. So, for instance, one of the things about the currency offsets, this is very interesting. So theoretically, if the U.S. imposes a tariff on another country, say China, then the dollar goes up against the Chinese currency. The Chinese currency goes down, the dollar goes up. Now, it doesn't work exactly that way with China because they're more manipulative with their currency. But in general, that's the way it works. And if you go back to the 2018 tariffs, which were mostly on China, that's exactly what happened. The dollar went up, the yuan went down. So if you think about that, it's called a currency offset for a reason. The movement in the currency offsets the tariff. So if the foreign currency goes down and the dollar goes up, then the price of the imported good does not change. Well, if the price of the imported good does not change, it doesn't change the demand for the foreign good, which means it doesn't affect the trade balance. So if you get currency offset, but the reason they're talking about that is because what that means is that the price of the foreign good, the imported good, doesn't go up. Well, if it doesn't go up, nothing's going to change. So why did you do it? There's another section of the paper where he talks about what's the main benefit of these tariffs. Well, the main benefit of the tariffs is this. This is what he says, and you can take this circular reasoning however you want. Sounds like a circular firing squad to me. He says the main benefit of these tariffs is that it will raise the price of the imports, which will reduce the demand and then reduce the price of the imports. What? So if the main benefit of the tariffs is to reduce the price of the imports, why are we imposing a tariff to raise the price of the import so that it can then fall in price? It doesn't make any sense. Anyway, the point is, look, this thing is it's a document that supposedly is kind of a blueprint for what they're going to try to do. It is so inconsistent and so contradictory. I don't see how anybody could take it seriously. And I will say this: I read this paper back in November. It seems to be getting a lot of attention now, here 4 months later. I read it when it was published because everybody knew he was going to be the head of the Council of Economic Advisors. And I thought, well, this is important. I should read this. And I'm going to tell you, I got to about, I don't remember exactly what page it's on, but it's within the first 10 pages. He talks about how a value-added tax, which is a tax, a consumption tax, essentially, a sales tax, essentially. It's a little bit different than that, but essentially it's a sales tax. And they have VATs in Europe, and they do raise a lot of money. But he compared it to a tariff and said it's similar to a tariff. Well, Bob, it's not even close to a tariff. It has nothing to do with tariffs. In fact, everybody in the economics profession on this planet knows that it's a neutral tax. It doesn't have anything to do with tariffs. It has nothing to do with imports and exports. So the first time I started reading it, I stopped right there. I was like, well, this is stupid. This, I'm not an economist, but I've been studying this stuff for 40 years, but I recognized immediately that this is a mistake. This is an error. Right in the main part of this thing, the very first thing he says is wrong. I'm like, how is this guy going to be the Council of Economic Advisors? And that's why I keep coming back and saying it was a job application. He was given a set of things that they want to do and told to come up with an intellectual framework for it. And he tried to do it, but he immediately had to make an error because it's not true. And look, I don't know any other way to put it except to say that that is basic economics, very, very basic economics. And he got it wrong. I don't know what they're teaching in economics classes in Harvard, but I guarantee you they're not teaching that. I'm pretty. Greg Mankiw of Harvard wrote the Econ 101 textbook, and I guarantee you that he would give him an F on that. So anyway, look, that's kind of where we are. We're trying to figure out what does this mean? What are they going to try to do? And what I'm worried about is the dollar more than anything else.
Well, there's another part to this too, because you said that uh, there has to be cooperation when you wrote your commentary this week. And so
Yeah.
the juggler is at the circus and all the balls are in the air, tariffs and currencies and all this other thing, but it doesn't seem there's a ball that says cooperation. I mean, I don't see how it works
Yeah.
without that.
It doesn't. It doesn't. And in fact, it's very interesting. He says at one point in the essay, and I quoted this in this week's commentary. He says that if other countries retaliate, the benefits of imposing tariffs goes away. And so he says that cooperation is absolutely essential to make this work because you have to prevent the retaliation. If you get the retaliation, it offsets all of the good that all of the theoretical good that you might get from a tariff. And the theoretical good is probably not real world anyway. But if other countries retaliate, he says right up front, if they retaliate, it won't work. Well, I don't know. It seems to me that if you're after cooperation, you ought not be browbeating Canada and say you ought to be the 51st state. And you ought not be telling Denmark that you got to give us Greenland. I don't know. That to me, that just seems like kind of basic common sense that if you want cooperation, maybe the way to go about it is not beat the other countries over the head. But that's what's happened. And so and he was actually, when he talks about the cooperation, most of that he's talking about, that's part of it. The other part he was talking about was trying to get the dollar to go down in a controlled way, in a multilateral way, where Europe would want the euro to go up and China would want the yuan to go up and so forth. Well, they have no incentive to do so. The only possible incentive, and this is what he said, and it seems to be what they're trying to do, which is that if you want if you want to be part of the U.S. defense umbrella, when we're talking about Europe, Canada, and so forth, then you're going to have to do this. You're going to have to make your currency go up. Well, again, I don't think being the bully on the block is the way to get cooperation. It just doesn't make sense to me. And indeed, look, the dollar is going down for a lot of reasons right now. But it's not because Europe wants the euro to go up or Japan wants the yen to go up. But that's not why it's happening. It's happening because I think we're making some kind of basic mistakes here. Listen, I don't know where this is going. I will say this. Look, everybody's focused on tariffs. I think that's the wrong thing to focus on. The thing that everybody ought to be focused on is the dollar. That's where the big impact on markets and economies is going to come from. If you devalue the dollar, especially if it comes down significantly, we know what the consequences of that are. We know what happens when we have a weak dollar. Just think about it this way. A weaker dollar, in a sense, means that capital is flowing away from the United States. And right now, President Trump is kind of pushing it away. And that just doesn't seem like a good idea when we got $36 trillion in debt. Maybe we ought to be trying to attract capital. And instead, we're pushing it in the opposite direction. Look, if we go down this path of a weak dollar, the outcome is not good. It means lower growth. It means higher inflation. It's just not a good look. And I won't just a warning. The last two times we had a weak currency, a weak dollar, both of them. Let's start with the first one. 1985, the Plaza Accord. The dollar was roared, went way high, 150 on the dollar index after Ronald Reagan was elected. Why? Because Ronald Reagan was going to do all these things, deregulation and all these things, and continue. And actually, in retrospect, you go back and look at it, it was a continuation of a lot of things that Jimmy Carter started. And Jimmy Carter was, universally believed to be a bad president, and that's true. But he did do some good things on deregulation. He deregulated the trucking industry, he deregulated the airlines. He did a lot of that. A lot of the things that Reagan did were a continuation and a deepening of what he was doing. And so a lot of capital came to the United States in that first half of the 80s, 80 to 85. The dollar soared. But just like now, back then it was Japan, now it's China. We were saying, man, Japan's eating our lunch, and it's because the dollar is too strong. And if we just weaken the dollar, then we'll solve this trade deficit problem. And so we had what was called the Plaza Accord. We got Japan and Germany, our two big trading partners at the time, to come to New York to the Plaza Hotel, which coincidentally was bought by Donald Trump right after that. Kind of weird. Although he paid too much, it went bankrupt. But anyway, the Plaza Accord was designed to devalue the dollar, to bring it down. And it worked. Oh my God, did it work? The dollar came down a lot. And at the end of the decade, what did we get? We got a banking crisis. Savings and loan crisis. Remember that little jewel? Savings and loan crisis. Now, look, there were a lot of reasons why we had the savings and loan crisis. And I'm not saying that the dollar was the sole reason, but it was part of it. So the next time we did this, and this time it was less deliberate. But from 2002 to 2008, the dollar went down a lot too. And what did we get at the end of it? A banking crisis. So heading down this weak dollar path leads to a very, very dark place. And so I think we need to be very careful about what we're trying to do. The administration, I said at the end, this may be one of those situations where you got to be really careful what you wish for, because you might get it good and hard. And so that's where everybody ought to be focused. The tariffs, listen, I've done some kind of back of the envelope math here, and you can't really figure all this out because there's too many moving parts. JP Morgan actually did this too. Their numbers are probably better than mine. They got some people on staff that are probably a little smarter than I am. The average impact of all these tariff plans, and they looked at all the different ones, VAT, Canada and Mexico. Roughly, you're talking about 0.5% of GDP. It's not a big number. 0.5% of GDP when you're going at 2.5%, you go from 2.5 to 2. It's not good, but it's not the Great Depression Part 2. But if you devalue the dollar in a big way, that's going to lead to much, much bigger problems. So I won't say forget about the tariffs, but that's misdirection. Don't pay attention to that. That's not where the problems are going to come from. The problems are going to come from what they do to the dollar. And I will tell you, I've said this many times. I was told many years ago by a pretty smart guy that a president always gets the dollar he wants. This president wants a cheaper dollar. So does his vice president. So does his Treasury Secretary, and so does the head of his Council of Economic Advisor. You put all those four people on one side saying we want a weak dollar, I think they're going to get it, and that's to our detriment. So anyway, that's kind of my look at it. By the way, we're one of the few firms out there that pays a lot of attention to the dollar. That's one of our two main inputs to what we do to make tactical changes to our portfolios is the dollar and interest rates. And we know what to do when the dollar goes down. We know the things that benefit from that and the things that get hit because of that. So we know what to do. And it's not hard to figure out. I'll probably be writing something about that soon and kind of go over what do we do in a weak dollar environment, because it's not that hard. And some of it's already starting to work, by the way. Gold is making new highs. That is something we normally would expect to see happen during a weak dollar environment. It's already happening. So some of this is already starting to go now. And some of it, another one, by the way, would be outperformance of international stocks, which you'll notice that's exactly what's happened since the beginning of the year, since the dollar started to go down. So, but if those trends are going to persist, those things got a long way to go. So anyway, that's my 2 cents worth. Mr. Miran's got his work cut out from him. I'll put it that way.
All right, Joe, thanks. Have a safe trip back. And if you would like to get Joe's commentary sent to you automatically every week, make sure you sign up for our free newsletter.